Hi, guys. Welcome to the 18th episode of WTW, the weekly trading wrap up, where we talk about the weekend markets from a trader's perspective, what to focus on and what to ignore. So let's begin. As usual, we're going to start with the S&P 500 SPY, and the arrow here denotes the week of the 17th. This was OPEX week, and it didn't disappoint, ups and downs, but finished pretty much unchanged. Okay, so despite a lot of stuff that is happening, unchanged. Okay, so let's just talk about the technical picture. We will always start off with a technical picture. Okay, so as you can see, we've had a 10% correction that regularly happens in a bull market. We are still in a bull market, series of higher highs, higher lows, although the recent ones were violated. This is still a series of higher highs and higher lows. Okay. And we can see this more clearly if we look at a weekly chart. This gives you a better picture of what to expect. Okay, look at this. This is a clear picture of a bull market, even though we fell down here. Okay, so let's put in some moving averages here. On the weekly, you can see the 50 week is important. It usually touches it. Okay, and you see this is the bull market that touched the 50 week. Okay, and it's staying there for 2 weeks. Let's go back to the daily. The daily, though, the 50-day moving average starting to roll over, but the 200 is still increasing, but we are still below the 200. For 2 weeks now, we've been trading below the 200-day moving average, and that is a key technical indicator that everybody looks at. Okay, it's not the end of the world, but so far we are trading below the 200 with extremely bearish sentiment. Let's go to the sentiment indicators that I like to look at. There's many, but I like the fear and greed index. We are still at extreme fear even after today, Friday, OPEX day. Okay, so we've been at extreme fear for basically 2 weeks. And even if you look at the AAII Investor Sentiment Index, for this week, we are still 58% bearish. We've been at extreme bearishness for a month. Okay, and how can I say this? An extreme light on the bullish sentiment for a month too. Okay, this is telling you how people think. However, it's not a timing indicator. We keep saying it because, if it's a contrarian indicator, but it doesn't mean it's going to snap back right away. And as you can see, we're still trading below the 200. Okay, so we have trading below the 200, which is a bearish sign. However, we're still, if we look at the chart here, we're still in a bull market, and in bull markets, we regularly have 10% corrections. Okay, so we need to recapture this 200-day moving average fairly quickly, and I think we will. Okay. Another way, let's get rid of these moving averages. I like to look at a clean chart. Okay. Another thing we could look at is some of the technical indicators here, like the RSI. Okay, the relative strength index is very classic. Okay, as you can see, if you can't get too cluttered, it never gets to the extreme oversold level, which is at 30. Okay, 30 under 30 on the RSI is oversold, and over 70 is overbought. We get to the overbought, but very rarely in this bull market do we see the RSI get below 30. It did when in the 2022 bear market there, it did, even just barely touched it. So it's very rare for the index to go below 30 before going back again. So here we see it hit it on the extreme pessimism when we were down 10%, when it was at 550, the index. So we went there and we're coming back. You see some of these MACDs and PPO, which is like a MACD. It's a percentage price oscillator. It's like the MACD. So the short-term moving average crossed over the longer-term, slower moving average. So the fast one crossed over the slow one, which is a sign of a buy signal, if you will. Okay, and you don't have to really look at these. I like looking at the chart and this giving me some support of my technical picture. Okay, so if we go back to the clean chart what I really like to see is a flush, bounce back, and hopefully forming a higher low. And now we have to break up above the 570 level. 570 was serving as resistance. So we need to break up above the 570. I think we do it next week. Next week, it's like we're coming towards the end of the month. It's pretty bullish. We've washed out a lot of people. Today we had OPEX on Friday, so a lot of the options expired. So, people were scared that on OPEX it was going to be a $4.7 trillion off OPEX. So the market opened lower, but then, as usual, OPEX, they just bought it back because people always look at the bad part. Oh, we have to sell 4.57 trillion worth of securities. Well, maybe people want to buy 5 trillion worth of securities. You don't know. You don't know the other side of the equation, as always. Okay, so the technical picture is still bullish, but we need to get above the 200-day moving average, this green line, which is still upward sloping. It hasn't rolled over yet. Okay, so we need to get above that. We have to get above that quickly so the sentiment could change and the narrative can go into more of a bullish narrative and get these indices here in the these gauges here back into the neutral and greedy territory before we can start selling what we bought. So that's the technical picture, okay? Let's get rid of these. Okay. We had a couple of macro prints this week that are significant that we like to look at. It's the first thing is the building permits, and then we had initial claims as always, okay? So the building permits came out, and they came out at 1.46 million, okay, which is within our range, okay? We don't want the building permits to start going down, okay? Like if you want to take a longer term view of the building permits, this is the Federal Reserve database, and these are the building permits. As you can see, they start going down before recessions. Not always, they didn't do that in the 2000, but do that 2008, they started going down a lot. Started going down a lot before the 1990 recession, before in the 70s here, in the late 70s and the 90s. And this is the 1990 recession, okay? So building permits start going down. I mean, here they're still hovering around this area without seeing anything collapsing, okay? So building permits still within a nice range. Then we had on Thursday, we had the initial claims. Initial claims came at 223,000 versus 221, always within our range. We don't want to see it exploding. If we go to the Fed database again, you can see the initial claims exploding right before recessions. We don't have that. They're actually going down. This is a very positive sign, okay? So as long as people are not filing for unemployment, we're looking pretty good, okay? So that was the macro picture. That's it. It was just building permits are okay, and so are the initial claims. Nothing to worry about. We're still good when it comes to the macro that we look at. So, of course, the big thing was the Fed coming out on Wednesday. That Powell sounded a bit more, sounded slightly dovish, okay? And this is what I was talking about. Like, he also said that, well, let's go back. He sounded dovish, but he also said that inflation due to tariffs is usually transitory and shouldn't be a big problem, okay? Because the narrative right now is that this tariff war is going to keep prices high, okay, which is inflationary. However, just like the OPEX that we had on Friday, we don't look at the other side. There's also deflationary pressures coming, okay? And he said that they're in balance. We have a slowing economy that should put a balance to these tariffs that are coming, to the one-time transitory inflation that could be created by tariffs. And this is important. People just glossing over this, but the fact that people just look at the tariff side and it's going to be inflationary and they ignore the other side is not good. This is what I'm saying. They just build narratives on one side and completely ignore the other side of the equation. Like OPEX, 4.7 trillion of securities needed to be sold. How many need to be bought? Nobody knows. Just like this, like the deflationary pressures of a slowing economy is, slower consumer too. Like the consumer might stop spending as much as they used to, and we know that spending is 70% of the U.S. economy. So if that slows down, there's not going to be inflation. And we're not printing any money, so there's not going to be any inflationary move that is beyond the transitory phase, like Powell said. So again, don't get caught up on narratives. You don't know the other side. You don't know the deflationary pressures are in balance right now, says Powell. I don't see why I shouldn't believe him. And they could be offsetting. Like, that's why rates are not exploding. That's why inflation expectations are anchored. Like if we look at break-evens, break-even. Look at the 5-year break-even rate. See, inflation is not shooting up. It's actually it's been going down since February. Okay, these are 5-year inflation expectations. Okay, we look at the 5-year break-even rate. The 10-year is the same thing. The 10-year break-even rate is the same thing. It's telling you that inflation has been going down since February. So the bond market is not stupid. They know what they're talking about. They see bond guys are smarter than stock guys. I hate to say that because I'm a stock guy, but whatever. As you can see, the inflationary pressures over the long term are well anchored. Like Powell is correct. Okay. Don't forget the deflationary pressures are in balance with the inflationary pressures, and maybe slightly more. You don't know. Okay. That's why don't make narratives. Don't jump aboard the narrative whenever somebody just says something. Okay. Take a step back and look at the second and third order implications of your analysis. Okay, we talked a lot in the past about gold and Bitcoin. Okay, we already know the picture about that. Okay, but what we didn't talk about, and what I would like to get into, is high yield bonds. Okay, HYG is the high yield bond index. Okay, as you can see. This is where we are right now. This is all of 2025. This is the beginning of 2025 right here. They went up, they went down, pretty much slightly higher. Okay, and if you can see, they're still within a range. As the market was tanking, this whole time the market tanked 10%. High yield bonds maintain this high level. Okay, high yield bonds are a sign of risk on. Okay, if you see the bond index before recessions, they tend to go down here. Okay, if you look at credit spreads, which we should. Okay, I like to look at the credit spreads in the Fed database. The CCC rated bonds are junk. Okay, CCC and lower bonds are junk, and this is the spread between junk bonds and pristine treasuries. Okay, for all of 2025 in the beginning, they were very low. The spread was low. There was no danger. It just started going up recently. And that's what the fear was. That's why the market was tanking, because spreads are increasing, which is bad. Okay, if you look at the maximum, credit spreads tend to go up right before recessions, up right before recessions, up right before recession. Like the 2000, they were going up for 2 years before the recession hit. Okay, in 2008 they started going up quicker. Okay, but it's not crazy. It's still in a general downtrend. If you look at overall, it's just recently gone up, but we're still in a general downtrend. Look at a 10-year. Okay, we're still this downtrend. Okay, we're not. It's a little bit worsened, but not so much. If you couple it, because this is the high yield component, this is the spreads. Okay, but if we look at just the high yield bonds, which is just the half of that spread, it's nothing. It's staying within the range. Okay, and this should be giving you a clue that this downturn, the bond market is not signaling to us that there's going to be a major downturn. Okay, as you can see, the high yield bond, because high yield bonds are positively correlated with the market. Okay, as you can see, they start tanking during the 2020 crash. We go back more, they start tanking right before in 2015 and 16. Okay, during the period where Janet Yellen was going to start raising interest rates. She raised it by a quarter point and then changed her mind and put it back down, and that's why we had a rip on 2016. But even the 2018 period when Powell was raising rates, look, high yield bonds were going down all of 2018, okay, up until the beginning of January 2019. Then they ripped again because they were risk on. So they're telling you risk off, you're going to see this kind of move, down, risk off, down. Are we seeing a risk off period right now? No. So high yield bonds are telling you that this is not a bear market. Okay, we're still in a bull market, and we saw from the technicals, we're still in a bull market. Yes, we had a little correction, but that happens normally in bull markets. Okay, and that's what I wanted to mention. I wanted to look at the high yield index with you guys and explain to you that this is not signaling anything bad. Okay? Not even close. In fact, it's just consolidated. It's signaling the opposite. Okay, and when we do rebound, this thing is probably going to go back up too. Okay. So I also like to look at China. Okay, let's see China. What's going on here? I like China. Okay, it's been going up recently, and it broke this key level here. Okay, this key on the FXI, which is the Chinese large caps. Okay, this is an index, ETF, I should say, and it broke the 3450 level, and it's consolidating near highs. Okay, for me, I like to play. As you can see, this -6. It's large caps in China dropped 61% during this whole bear market, 2022 till now. Okay, they've been in a 2-year bear market, and it just started coming out of it. Okay, so I'm bearish because they're starting to stimulate. I'm bullish, China, and I like to play BABA. That's my vehicle. There are many you can play. Okay, and BABA, you can see BABA got destroyed even more. It was down 80% from highs. Okay, but as you can see, it broke above this key level, consolidated here when I bought, sold around here, and then high tight flag type of formation. I'm hoping that it goes down and I start buying back again here because I'm really into China. Okay, right now I don't really want to get into it, although it's probably a good trade. If it breaks above here as a high tight flag, it's probably going to keep going. Okay, so that's what I'm looking at. If not, I'm looking for a crash, some kind of bad news out of BABA that'll make it go down here, but it's just BS bad news. Okay, because I believe that China right now is coming out of its bear market. Okay, so we looked at China. We looked at the high yield index, which is telling you don't panic. We looked at the technical picture, which is still good and forming a higher low. I always like to look at low, rebound, higher low, break above the 570 level, which is key. And we're going to continue this. The next leg up will happen after we break above the 570 level. And that's where things stand for me right now. Looking forward to the last week of March, which should be bullish. And until then.